A home equity loan, sometimes called a second mortgage, is a fixed-rate loan that lets you tap the equity in your home. By putting up your house as collateral, you can obtain the cash value invested in your property at a lower interest rate than most consumer debts. Whether you need cash to renovate your house, pay for an upcoming wedding, or pay down high-interest debt, a home equity loan provides the necessary funds to achieve your goals. But home equity loans aren't the right choice for everybody. And if you don't pay up when the piper comes to visit, not only will you tank your credit score, but you might lose your house too. What is a home equity loan? A home equity loan is a fixed-rate loan that you receive in one lump sum and repay in monthly installments. Borrowers may secure up to 85% of the equity in their home for personal use, debt consolidation, or even take a vacation. Equity is calculated as the market price of your home, minus any mortgages or debts against your house. But be warned, although borrowing against your home can provide hundreds of thousands in funding, it also means that defaulting can leave you in worse shape than where you started. As such, it's crucial to take out only what you need or can repay, not what you qualify for. How do home equity loans work? Home equity loans let homeowners pull cash from one of their biggest assets without breaking the bank. To secure a loan, you'll have to contact your mortgage lender or other financial institution. Don't be afraid to shop around for the best rates. Then, after you've applied for a loan and accepted a proposal, you'll have to cough up fees and closing costs, which may range from 2 to 5% of the total loan amount, although some lenders waive these fees. Note that these fees are in addition to the fixed interest rate you'll pay over the life of the loan, which may start as low as the prime rate plus 2%. However, your income, employment history, credit history, and debt-to-income ratio may also factor in your total interest rate. Once you received your lump sum funding, you'll typically have to start making payments within a month or so for the life of the loan, which may range from 5 to 30 years. And because these are fixed-rate loans, your monthly payment will remain the same for the life of the loan, unlike variable-rate debts. But keep in mind that home equity loans operate just like a mortgage. If you don't meet your obligation, the lender has the right to repossess and sell your home to cover their debts. Home equity loan requirements. Just like other debts, home equity loans come with their own requirements. Here are the requirements you need to know about. Number 1, credit score. Your credit score often factors into whether you can take out a loan, how much money you can borrow, and your interest rate. Typically, the lower your credit score, the higher your interest rate, as collectors view you as more of a lending risk. When it comes to home equity loans, most lenders want to see a credit score of 620 or higher. However, some lenders offer exemptions to the rule, for a price, of course. Number 2, minimum home equity requirements. The rule of thumb for home equity loans is to own at least 15 to 20% equity in your property before you use it as collateral. Number 3, debt-to-income ratio. Lenders also consider your debt-to-income ratio, or DTI, when evaluating your situation. This is how much you pay in monthly debts, such as your mortgage and credit card bills, compared to your monthly income. To qualify for a home equity loan, your DTI can't be higher than 43%. Number 4, ability to repay the loan. And lastly, lenders want to see that you have the ability to repay your obligation. To do so, your income, employment history, credit history, and DTI must demonstrate your good faith willingness to pay back your home equity loan. How do you get a home equity loan? Prepare yourself to jump through a few hoops before you run out to apply for a home equity loan. After all, you're putting your house up as collateral. It's in the lender's best interest and yours to make sure your T's and I's are crossed and dotted. Step 1. Calculate your home equity. Equity is the difference between your home's value and what you owe on your mortgage and other house-backed debts. So, if you own your home outright, your equity is 100%, and you can borrow up to 85% of your home's total value. But say you buy a $200,000 house and pay off $100,000 of your mortgage between your down payment and regular monthly installments. If you want to take out a home equity loan on what you own, you can only borrow up to 85% of the $100,000 you own. If you want to calculate your home equity yourself, start with the market value of your home. If you're unsure of your home's value, you can use websites like Zillow to approximate the value. Then subtract the balance of any loans against your house, including your mortgage, home equity lines of credit or HELOC loans, and personal loans. Step 2. Get your home appraised. Some lenders require a formal appraisal before offering a loan against your house. You can either take this step preemptively, or you can wait until your lender requests one. Keep in mind that an appraisal can be a double-edged sword. If the value of your home has risen since you've moved in, you may own more equity than you thought without paying a penny more. But if the value of your house has fallen, you may own less, or even find that you're underwater on your mortgage. Step 3. Apply for your loan. Once you've gotten your appraisal, it's time to apply for your loan. At this point, you should shop around for different lenders and rates to find the terms that suit your needs best. Don't forget to look at credit unions, which may offer more personalized service and better interest rates, though the application process may take a little longer. After you've selected a lender, put in your application. The lender will assess your risk and overall creditworthiness before making an offer, which will detail how much money you can borrow, your interest rate, and terms of repayment. Step 4. Accept your offer. Remember that just because you qualify for hundreds of thousands of dollars doesn't mean that you should take out the full amount. Typically, you should only pull out what you need. If you're not sure how much that is, for instance, if you're renovating your home and only know an approximate value, it can be wise to pull out a little extra. However, again, only pull out the maximum amount you think you need and pay it back if there's any left over. Now, you may be asking yourself, when should you consider getting a home equity loan? Generally, home equity loans are best if you know that you're going to need a large, specified sum of money, as you're guaranteed a final loan amount at closing. For instance, if you need to consolidate other debts, pay for home renovations or remodels, or cover college tuition, a home equity loan provides a way to cover your obligations. And if you're worried about high interest rates, nabbing a loan while rates are low means you'll avoid the volatility that may come with HELOCs. Now that we know how home equity loans work, let's cover some of the advantages and disadvantages. What are the advantages of home equity loans? Lower interest rates than unsecured loans. Easy to plan payments due to fixed interest rates. Interest may be deductible on some home improvement projects. Longer terms than most consumer loans. No restrictions on spending funds. Access to a large lump sum. Unfortunately, nothing is perfect. Here are a few disadvantages that you need to be aware of. If you fail to repay, your lender may foreclose on your property. It reduces home equity and may keep you in debt longer. Closing costs run up to 5% of the loan amount, or $5,000 per $100,000 borrowed. If your home's value drops, you'll take a loss when you resell the property. Interest accrues on the entire loan amount. It is risky to take on a second mortgage if you don't own your home outright. We just covered pretty much everything you need to know about home equity loans, but let's take the time now to address the elephant in the room. Are home equity loans hard to qualify for? While the equity is technically yours to borrow against, qualifying for a home equity loan is another story. Requirements vary by lender, but you can usually expect to need proof of consistent employment or income, a FICO credit score of 620 or higher, a clean credit report, 15 to 20% equity in your home, a maximum DTI of 43%. And finally, home equity loans come with helpful tax deductions. Another unique benefit of home equity loans was written into law in the Tax Cuts and Jobs Acts of 2017. This law suspended the deduction for interest paid on all home equity loans and HELOCs until 2026. However, if you use the funds to buy, build, or substantially improve the taxpayer's home that secures the loan, you may still be able to write off the interest. Let's review what we just learned. Taking out a home equity loan lets you borrow against the equity you already own in your property. Your lump sum payment means you'll have the cash on hand to cover necessary or even frivolous expenditures when you need it. And because you secure your debt against your home, you won't break the bank to pay for your purchases either. However, failure to repay your loan could tank your credit score or even put you in foreclosure. As such, if you're worried about your ability to repay, you might opt for a less risky alternative than using your house as collateral for your debts. If you like this video, then make sure you hit the like button, subscribe, and join us every week as we break down personal finance topics in plain English. See you next week.